The aim of superannuation is to build a sufficient amount of wealth to fund an individual's retirement. Leanne Hayes from Accurium has joined me today to touch on a few provisions within the law that can help boost this objective. Hi, Leanne. Welcome. Thanks for joining me.
Thank you so much for having me.
I might start by talking or having you talk about the main residence exemption as one of these things within the law that can obviously help with this objective. So how does that work?
Well, the main residence exemption is a series of provisions that can basically mean you can sell probably one of the biggest assets that many of us own and not pay a cent of tax on it. In fact, the government actually identifies the main residence exemption as being one of the biggest tax expenditures that they have. Now, by tax expenditures, I mean a measure within the law that costs the government the most. By having the main residence exemption, this is the revenue they sort of forgo. Main residence exemption, it's broken down, I guess, into two parts because we're talking about the disposal of a CGT asset. We get a 50% discount where we're an individual and we've held that asset for more than 12 months, which is typically most people's home. But on top of that, we have a series of very specific provisions that say if you've lived in a house as your main residence, then it's outside the tax net when you sell it. Even if we have a property that has not been our main residence during our entire ownership period, the rules still give us the ability to recognise the period of time that we did own it or did continue to choose it as a main residence, even if we're living elsewhere. So there's some fantastic strategies involved with just kind of planning which property is going to grow in value the most and give us that ability to walk away with that tax-free gain. So we can even get it for properties that perhaps we have lived in, are now renting out and then sell, provided we're not claiming the exemption elsewhere. We do need to be careful. The legislation only gives you sort of one property for which you can claim this. But that gives us that kind of planning scope. And given, as I said, that the properties tend to be one of those really big assets that most taxpayers have, putting your wealth and putting and investing into that property and then realising it is obviously a really wonderful way to maximise your retirement savings later.
Wow, that's great, Leanne. I just noticed that you touched on CGT in that brief discussion just then. And of course, that's a great segue into the next thing that we want to talk about, and that's the small business CGT concessions that can also really boost your superannuation.
Absolutely. Again, what a wonderful set of provisions these are, allowing you to sell things like your business real property, put the cash in your pocket and not pay a cent of tax. Now, of course, to get to that end position, there are rules and the like that we need to understand, make sure we adhere to, and then obviously apply appropriately. But the small business CGT concessions, like the name suggests, is focused at that kind of smaller end of the market. So it's not for everybody, but it is for those that have chosen, I guess, to kind of invest in the future, but do that with respect to the properties that they're using in their business at the moment. So business real property, or even the goodwill in your property, the goodwill in your business, or maybe even the equity in your business. These are the types of things that we can sell. And again, provided the ducks line up, walk away with the tax-free gain. The beauty of the small business CGT concessions as well is sometimes that gain is able to be put into super outside your standard non-concessional contribution caps, which we all know is a really, really useful mechanism. We could also make contributions disregarding our total super balance from the year before. So again, depending on what I guess you've done in the past, that might be quite a useful strategy as well. Again, we do need to be careful. There are timing rules. And the magical age of 55 becomes relevant here. If we're talking about something like the retirement exemption, under 55, the money has to go into super to get that tax-free status. But once you get to 55 or above, you've got a little bit more flexibility. You might choose to put it into super, you might not. You might put it into super and use the normal non-concessional caps because you might get a better advantage by preserving your CGT cap until another day. But again, these are all strategies we can talk about.
Yeah, that's brilliant, especially considering that a lot of small business owners actually don't make regular superannuation contributions, and the selling of their business is really their superannuation plan, I suppose, strategy. So those provisions are really helpful and really, really powerful, I think. One of the rules that probably garners a little bit more discussion than the two we've just talked about is the ability to carry forward unused concessional contributions caps. Now, this can be really good to just obviously make bigger contributions than you probably think on a yearly basis.
Yeah, absolutely. And I guess, in a sense, a relatively new measure, 5 years or so. But what this does is allow those years where your concessional contribution hasn't been fully exploited, carry that forward and use it in a later year. So we can carry the unused amount up to 5 years and then use it at any kind of later point in time. So any year that you make a contribution, a concessional contribution, you use up that year's cap first. But if you go over that year's cap, that's when you can start utilising these previous ones that you can carry forward. We carry them forward on a first in, first out kind of thing. The key, however, two probably key things to note is that you can only utilise this if your total super balance 30 June the year before was below 500,000. So again, thinking about your timing with that is pretty important. It's also important to note that the contribution then can count towards the adjusted taxable income for your Division 293. So again, just making sure we warn or caution our clients on that, depending on what kind of other transactions and the like are happening anyway. But again, really useful strategy if you do happen to have that one-off capital gain, you've sold some shares, something like that, you can manage that kind of tax flow by making that contribution into super and getting that tax deduction for it.
And then finally, Leanne, something that statistics show has been a very successful measure by the government, and that's the downsizer contribution provisions. They can be of great benefit here as well, can't they?
Oh, absolutely. And I love that it's called a downsizer. There's absolutely no requirement to downsize whatsoever. And we all know that sometimes downsizing doesn't actually necessarily mean cheaper either. But what it does is it gives you that one-off opportunity to put this extra amount of money into super. Again, disregarding our total super balance, we can put this amount into super and obviously grow that retirement nest egg. So you do need to have a few ducks line up to get it. And again, that's the strategy that we'll be discussing behind it. But where you do have this, as I said, this is that one-off extra additional contribution that you can make. And there's no requirement to use the money from the house you've just sold. There's no requirement to buy another property. There's no requirement for that property to be big or small or whatever. There's also a lot of flexibility in there to make sure that both spouses in a relationship can get it too. So the non-owner of the property in that relationship still might be able to use the downsizer contribution to the full value as well. So it's a really useful one. You don't want to miss the opportunity if it arises.
Thanks, Leanne. That was a great discussion.
Thank you. Thank you for having me again.
Leanne will be covering this topic in more detail at the SMSF Professionals Day 2025, co-hosted by Self-Managed Super and Accurium. It's a three-city roadshow with the event kicking off in Sydney on the 22nd of May and concluding in Brisbane on the 29th of May. There's also going to be an online component. To find out more about the event and register, please refer to the details you can see on your screen now. Thanks again for your time today, Leanne, and I look forward to your presentation at the SMSF Professionals Day this year.
Thank you.